Seasonality is the phenomena where during certain times of the year, markets behave almost predictably. It's rooted in the idea that investors and businesses and economic cycles have regular patterns. These patterns aren't quite as regular as the phases of the moon. They don't always work, but combined with other factors, they can take on a life of their own. I'm Barry Ritholtz, and on today's edition of At the Money, we're going to discuss what you need to know about market seasonality. To help us unpack all of this and what it means for your portfolio, let's bring in Jeff Hirsch, editor-in-chief of the Stock Traders Almanac, who's been studying seasonality just about his whole life. Jeff, welcome.
Hey, Barry. Great to be with you.
So let's talk a little bit about this. I mentioned certain things happen every year. Mm-hmm. People raise money to pay taxes. They pay taxes certain times of year. They make regular contributions. What does the data you study say about seasonality?
It says that people are creatures of habit, and it's a behavioral finance at its core where people are doing the same things over and over on a regular basis. You mentioned in the intro the 401k contributions. One of the things that I learned early on when I started working for my father was about that mid-month spike. So he had promoted a pattern for years, the best 5 days of the year, the monthly 5-day bulge, which was the last trading day of the month and the first 4 of the new month, which is when people pay their bills and make all their transactions on a monthly basis. And I used to do those numbers by hand, using the Barron's Market Lab pages and underlining stuff and using an anti-machine and all that by hand work, which was educational. But there we are looking at the pattern. We see it change. There's a spike mid-month. And we're looking at each other, we're talking about it, and we realize that was this new pattern of people with the payroll deductions going into the market, and fund managers have to be long. So there is this spike where cash is coming into the market during the middle of the month, and you have that sort of super 8 days of the month now where you have the middle 3 and the last 2 and first 3 that become that seasonal pattern. So
my partner, Josh Brown, calls that the relentless bid. Your dad, Yale Hirsch, founded Stock Traders Almanac. Gee, is it 60 years ago? How long ago was that?
It was 1966, the year of my birth.
Wow, that's absolutely amazing.
Born, bred, weaned, raised on all these patterns.
So one of the things that he has discussed and you've written about continuously is, hey, it's not just the calendar. You have to look at things like technicals, fundamentals, sentiment, fund flows, monetary, etc. How do you sort of take all these different factors and combine them with seasonality?
Well, I mean, right now in 2023, seasonality, the 4-year cycle, the president's cycle are firing on all pistons. It's almost too easy. It's not always going to be that way. But we are always combining fundamentals, macroeconomics, monetary policy, and technicals with sentiment, and you're looking at it. And it depends upon, like any fund manager or any trader, which factors are leading and driving the market at any given time. And we're always looking for things that are, outliers and things that people aren't thinking about. Contrary thinking is part of it, but at our core, it's always about cycles. People are creatures of habit. They do things on a regular basis every day. I mean, people get up the same time, they have lunch the same time, they go to bed the same time, the market closes the same time, it opens at the same time, and you see these patterns continually persist. So that's sort of our bias, but we look at, technical setups, and one of the key things is, if the market or the stock or the sector is tracking that pattern closely, then gains beget gains or losses beget losses. And if it's diverting, that's when we might not take advantage of a seasonal pattern because it hasn't come in setting up correctly or tracking the pattern closely.
So we're recording this a few weeks before Christmas. Let's talk about some of my favorite seasonal patterns that you write about in Stock Traders Almanac. Santa Claus rally. What's happening with that?
Everybody gets it wrong year in, year out. Yale, my father, devised this indicator back in 1972, came out in the 73 Almanac. It is this tendency for the S&P 500 to gain 1.3%, not a huge number, over the last 5 trading days of the year and the first 2 of the new year. It's not the rally, the year-end rally, the fourth quarter rally from Halloween to January that everyone likes to use that for
The
their
best
buzz.
few months of the year.
It's not the best few months of the year. It is this indicator. And as Yale, everyone forgets who created he was a songwriter, Barry. He could coin a phrase, my father. The line is, if Santa Claus should fail to call, bears may come to Broad Wall. And what that means is that during that last week of the year when, you might be away, I might be doing some family things, and the pros are on this, on their desk buying up bargain stocks that were sold for tax loss selling. If they're not doing that and the market doesn't rally during that time, it's an indication that things are amiss.
So let's talk about the January effect. What does that mean?
Well, the January effect, not to be confused with the January Barometer, the January effect is a tendency for small caps to outperform large caps in January. And as we show in the Almanac, most of that January effect is really the December effect now. It takes place.
Dumped those stocks in December, and now they're buying them back in January.
Right as we're speaking here, we're coming into that mid-December period where small caps start to take off versus large caps. We've seen the Russell 2000 already begin to perk up as it does around the end of October. But the January Barometer, which is the other seasonal indicator, is as January goes, so goes the year. Another Yale invention at the same time in 72. And we've seen January take it on the chin a bit in recent years.
I saw a really interesting analysis of the January Barometer that said it's not limited to January. It's essentially a momentum measure. Any strong month usually leads to another strong month.
There is the gains begetting gains. We've compared all the monthly barometers of every single month.
You like January the best.
Not just like it, but we've looked at it from the subsequent 11 months, the subsequent 12 months, and the whole year. And the thing that happens in January is that it's the beginning of the year. It
sets the tone.
It sets the tone. And the reason why the January Barometer works is the 1933 lame duck amendment to Congress. When they passed this, newly elected senators and Congress people would take office 13 months later,
right,
after they were elected. Hence, lame ducks. And presidents were also inaugurated in March. There was a whole period where
now it's January, right?
Winter was tough back in colonial times to get to D.C. So it moved inauguration to January 20th. New Congress is convening to the first week of January, and everybody, including present company here, makes forecasts, outlooks, sets agendas and precedents. You have State of the Union addresses, and a lot of forecasts.
So it tends to be an optimistic time of year.
It tends to be optimistic, but also it's the time where people are looking to the future.
So you mentioned Congress and presidents. Let's talk about the presidential election cycle. I know you've been writing about this for as long as I know you. We're in the third year of a president's term. That is your favorite year.
It is the most bullish year, but I want to just finish one thing on January if I can. There's a new wrinkle we've added to it. Since January has had some trouble recently with a lot of profit taking, we've taken the old first 5 days of the year, which is the early warning system, it's also in the Almanac, plus the Santa Claus rally, plus the full month January Barometer, created something called the January Indicator Trifecta. Since 1950, when the three are up, the Santa Claus rally, first 5 days in a full month, the S&P has been up 90.3% of the time, 28 to 31 years for an average gain of 17.5%.
That's pretty big.
Pretty good numbers.
How did the numbers look last year after we made those lows in October of 22? Did you have the trifecta?
We hit the trifecta in 23. Guess what? 22? No
Did
trifecta.
not.
In a midterm year, which segues back to your question about the 4-year cycle, which, you talked about things happening on a regular basis. There's only one country in the world that elects its leader on the same day every 4 years. That's the United States. Everyone's got these parliamentary votes and no
call for an election. Yeah, it's a week later and they're done.
So,
which, by the way, in America, that doesn't sound too bad. Get it over in a week.
Well, we can get into politics and ideology, but the cycle here is, the pre-election year is the best year of the 4-year cycle, up about 16.8% in the S&P since 1950. We see the midterm lows that move from the midterm low like we had last year.
Worked really well.
Yeah. I mean, average gains about 48% for the Dow from the midterm low to the pre-election year high, and it's about 68% for NASDAQ. And what I've seen and what I show when I present to people is that amazingly, there's a good cluster of lows in the midterm Octobers. We know that October is a bear killer and another one of Yale's phrases. But a lot of the highs, the yearly highs, occur in December, and a good chunk of them on the last trading day of the pre-election year.
Now, how much of that is just window dressing, and how much of that is just people have cash that they have to allocate in the calendar year, and they're just putting it to work?
I think it's a lot of both of those.
Yeah.
I mean, window dressing happens every year. Window dressing in September is what creates the negative period.
September, the fiscal year that ends September 30th.
And also the October 31st mutual fund deadline by the IRS, where you got to file, you got to reconcile your accounting for the 10 months and the 12 months. And, you know.
So let's talk about what I know as your all-time favorite seasonality factor. Sell in May and then go away.
I always say you got to buy in October to get your portfolio sober. So, again, this was something that, David Aronson is a technical technician through the CMT organization as well as Baruch College. He did a book in 2008, which was our best investment book of the year, called Evidence-Based Technical Analysis.
Oh, sure. I remember that.
So what he did was he took 6,000 plus, about 6,200 different black box systems and put them through the scientific method, which I had to learn what that is, that testing the null hypothesis.
Taking it out of sample, running it against other issues, not just cherry picking the best assortment of dates.
Right, and seeing if any of these systems had predictive power or were just the result of chance. So when we picked that book, we said, David, can you take the best 6 months and do the same thing? So he took it from, Yale invented that strategy, the best 6 month switching strategy, and it was in 1986 in the 87 Almanac. So he took it from 87 forward. So that he didn't have any of the backtest bias in there. And he found that unlike any of the other 6,000 plus different black box systems, the best 6 month switching strategy had predictive power, and the results were not the result of chance. So it is one of the main overlays we have in our newsletter and portfolio construction that we do.
So rationalize this. What is it about May, June, July, August, September that seems to be so meh?
Well, I mean, I mentioned the October 31st mutual fund deadline, which creates that sort of low period. But you have most of the human race, most of human beings live in the northern hemisphere, right? Most of the land mass is up there. So we have, this period of time where, there's a lot of light from May through September,
right,
and we do a lot of other things. I've seen you go on fishing trips. I play a lot of golf. My kids go to camp. People go on vacation. Okay, and, you remember.
Everyone's distracted elsewhere.
Everyone's distracted, and, when you have lower volume, stocks tend to go down, especially, after you've come into the Q4 and Q1 with all that extra money and all that extra buying. So it's a not a vicious cycle, but it's a regular cycle of the flow of cash and money in and out of the market. And people try to debunk the best 6 months by going back to 1896 when the Dow started. And, it didn't work back then, but back then.
People really didn't go on summer vacation. There weren't a lot of sleepaway camps back then.
No, and it was a farming agrarian society where
that was work time.
Where it was pretty much buy and May in the first half of the last century, the 20th century, where money would come into the agriculture. They'd be buying a fuel, seed, fertilizer, equipment, and they also were borrowing money. And then when the loans came due at harvest time is when the market would roll over in September.
So this is the inverse of that. So what's the worst month of the year for stocks?
August or September, depending upon if you go back to 1950 or 87 post-crash. So, and they delivered this year back to back.
That was the low. August, September was the low this year. And we had an amazing November following that. October was pretty good. November was on
the
fire.
Turn. October was the turn, which is, there's a picture from the 69 Almanac, which shows that, October, bear killer, bargain month, the best time to buy stocks, especially small and tech stocks.
What are the best months for the year?
November, December, January are the three best consecutive months. We've seen, October get better on the turnaround, but basically November, December are the best. January has gotten a little bit weaker with profit taking that seems to happen in the new year these days.
Last question. We're coming up on the fourth year of a presidential term. It's an election year in 2024. What does seasonality tell us about presidential election years?
Well, we have a sitting president running for re-election, and our research shows that, as we all know, the market hates uncertainty. So with the same person in office who's running again, whatever the polls say is one thing, but the fact that the potentiality of the same policies, the same economic, civic, and market-oriented policies are going to be in play, or at least the same mentality. The power of a sitting president is really undeniable. Years when you have a sitting president running for re-election, the Dow is up. The S&P is up 12.6%, 12.8%, and when there's an open field, it's minus 1.5%.
That's very interesting.
For us,
you think it's bullish having a president run for re-election, even if it's against a prior president?
There's not a whole lot of data points for
1800s. You got to go back a century and change.
What's it? One?
Amazing.
That's not a pattern. But anyway, we're bullish for 2024.
It's important to note that while these seasonal trends have been observed historically, they're certainly not guarantees of future performance. Markets are influenced by a wide array of factors, and past patterns do not always predict future results. Markets may have become more efficient than ever between algorithmic trading and AI. Maybe that could have an impact on seasonal trends. Regardless, investors should be aware of seasonality and what it might mean in combination with all those other factors for their comprehensive investment strategy. I'm Barry Ritholtz. You're listening to Bloomberg Radio's At the Money.